The climb in metals isn't a feel-good rally anymore. It's turning into a positioning problem, and someone is already getting forced to move. You can feel it in the way the tape breathes. Sharp bursts, thin liquidity, sudden air pockets, and then a snapback that looks irrational until you remember how futures markets actually work. Because the conflict right now is not whether metals are interesting. The conflict is whether this move is being driven by a clean wave of new buyers or by a messy reshuffling of exposure, where the wrong side is getting squeezed out one margin call at a time. And if it's the second one, the next week or two can look nothing like the last week or two. That's the payoff we're building toward. The levels that matter, the calendar trigger that makes those levels dangerous, and the one underappreciated detail that tells you whether this is a trend you can trade around, or a pressure cooker that's about to vent. Start with what repositioning really means, because people hear that word and assume it's just a polite way of saying some traders took profits. That's not what's happening when metals are trending and volatility is rising. Repositioning is a mechanical process. It's dealers managing option books. It's funds rolling futures to different months. It's producers and consumers changing hedges because price moved far enough to force new decisions. It's risk managers tightening limits because variance just spiked. It's not a vibe, it's flows. And flows don't care how confident anyone feels. That's where the real pressure starts. Look at the price context right now. In gold, the benchmark futures have been trading around the low to mid $4,600 per ounce in recent sessions, with prints near about $4,606 on CME's benchmark contract. Silver, which has been the wild one, recently pushed above the $90 neighborhood and then snapped back hard into the mid to high 80s, with the January contract trading around the mid 80s. Copper has been trading around the 6 per pound area on COMEX, and on the global benchmark side, it's been flirting with levels around $13,000 per metric ton on the LME. Those are not small numbers. Those are the kind of numbers that force the entire ecosystem. Miners, refiners, fabricators, banks, CTAs, market makers, to reprice risk. But that's not the part that matters. The part that matters is what's happening underneath those prices. Volume, open interest, spreads, and the incentives of the players who can just have an opinion and walk away. Here's this mainstream story you are going to hear. This is just another macro trade, safe haven headlines, inflation protection, maybe a little debasement narrative, and a lot of speculative froth. That story is convenient because it implies the move is optional. It implies that if the mood changes, the rally just politely fades. But when metals trend this hard, the market structure itself starts doing the buying and selling. And once market structure takes over, the headlines become a distraction. Because if one level breaks, the math changes. So let's put the hidden detail on the table because it reframes everything. Price can rise while open interest falls. And that combination is often the fingerprint of shorts getting covered and exposure being reduced into strength rather than new money enthusiastically piling in. In gold futures, we've seen sessions where open interest dipped even as the market stayed elevated. That matters because open interest isn't sentiment. It's the inventory of obligations. When open interest drops, it means contracts are being closed out. And if price is holding up while contracts are being closed, you're looking at a market that is absorbing selling pressure or absorbing profit taking while still maintaining the bid. That's not a weak market. That's a market where the remaining holders are stronger and the path of least resistance can stay higher. And that's where squeezes get born. Not from euphoria, from cleanup. Because cleanup reduces the amount of paper supply willing to lean on price. The next detail is what flips the whole setup. Now, how does repositioning become forced buying? It's simple and brutal. Futures are leveraged instruments. You post margin to control a large notional amount. When price moves against you, you don't get a gentle nudge to reconsider your thesis. You get a margin call. And margin calls don't negotiate. They force action. If you're short and the market rips higher, you have 3 choices: add margin, reduce position, or get liquidated. In a calm market, adding margin is manageable. In a volatile market, the margin requirement itself can rise, and suddenly, even a small adverse move becomes intolerable. That's how short covering turns into a spiral. First it's rational, then it's urgent, then it's forced. And forced buying tends to happen when liquidity is thin, which is exactly why the calendar matters right now. January is notorious for weird liquidity pockets. Some funds are still getting positioned for the year, some desks are still ramping up risk, some players are cautious after year-end volatility. That means there are moments, especially around overnight Globex sessions, around macro data releases, and around the approach to a major central bank meeting where the order book thins out. When the book is thin, a normal amount of buying can move price a lot. When price moves a lot, margin pressure rises. When margin pressure rises, weak hands sell or cover. That's the loop. And it's not emotional, it's math. Now let S talk about the paper versus physical tension without doing the cartoonish version of it. Nobody needs to claim a shadowy cabal to understand incentives. Futures are a price discovery mechanism. They're also a hedging mechanism. They're also a leverage mechanism. Physical markets are slower. They involve logistics, refining specs, delivery windows, credit terms, and real-world bottlenecks. When futures markets move first, physical markets don't immediately disagree. They adjust on a lag. And that lag is where spreads and deliverability signals become the tell. This is where a lot of retail investors get trapped, because they only watch the headline spot price. But professional metal desks watch structure. They watch whether the front month is expensive relative to deferred months. They watch whether the market is in contango, future months higher than near months, suggesting comfortable supply and storage economics, or whether it's in backwardation, near months higher than deferred, suggesting tightness and urgency for immediate metal. And you don't need perfect data to use this. You just need a habit. Look at the curve. Because the curve is where the truth leaks out. Take copper as an example. The futures chain has been showing higher prices in later months compared to the near month, which is a contango shape. On its own, contango says there's a carrying cost and the market isn't screaming immediate shortage. But here's the nuance. Even in contango, if the front month starts climbing faster than the back months, that spread can narrow, and that narrowing is often the first hint that nearby availability is getting tight, or that people are scrambling to cover near-term exposure. And that's where the real pressure starts. Now layer in the institutional narrative, because institutions don't just influence price with opinions, they influence price with allocation and hedging. In base metals specifically, analysts have noted that there were massive inflows into base metals over the last year, with copper drawing the lion's share. When you get that kind of flow, it's not just one type of buyer, it's trend followers. It's commodity index exposure, it's macro funds, it's relative value desks. And they don't all exit the same way. Some will sell on a signal. Some will sell because their VAR limits got hit. Some will hold because they're hedging something else. That creates asymmetry. And asymmetry is why metals can stay irrational longer than your conviction can stay solvent. This is also why we're already hearing respected shops warn that most of the rally has happened to win copper and that a correction is likely. That's not just a call on fundamentals. It's also a recognition of positioning. When a market is up 20% plus in a relatively short time, and when you've got evidence of speculative participation, the risk of a fast downdraft rises. But that doesn't mean the bull case is dead. It means the path gets violent. And that's exactly why you need a two-scenario lens, not a one-line prediction. Because if you insist on one outcome, the market will use volatility to break you. Before we go to the roadmap, we need to stack proof points, because one argument isn't enough in a market like this. Proof point 1, the price action itself. Gold near the 4600s is not a casual move. It's a regime shift in nominal terms. Silver above $90, even briefly, is not normal behavior. And the snapback into the 80s tells you liquidity and leverage are in play. Copper near 6 per pound and around $13,000 per ton on the global benchmark side is a statement, not a shrug. Proof point 2, open interest and activity. In copper, open interest has been rising even as daily volume varies, which suggests participation is growing, not just a one-day frenzy. In gold, you've seen days where open interest falls, which can indicate exposure is being closed rather than freshly opened. Those are different fingerprints. Copper's fingerprint looks like more people are getting involved. Gold's fingerprint, at least on some sessions, looks like the market is cleaning up while holding price. Both can fuel volatility, but the cleanup while holding price signal is the one people underestimate. And that's the hidden detail that reframes the story. Proof point 3, macro crosscurrents. The narrative that gold only goes up when yields go down has been breaking. Metals have been strong even with meaningful yields still on the board, which tells you the bid is not just a simple rate story. It's diversification demand, currency confidence dynamics, and hedge demand, plus the mechanical flow from derivatives positioning. And that's where the next detail matters. When the move has multiple engines, it becomes harder to stop with one headline. Proof point 4. Industrial behavior and substitution. Silver is not just a shiny store of value. It's an industrial metal with heavy usage in electronics and solar. When price spikes this hard, analysts and industry voices start talking about substitution, using cheaper materials or reducing usage. That creates a ceiling risk, but it also creates a timing risk, because substitution doesn't happen overnight. It's a design change, a procurement change, a manufacturing change. That lag can keep demand sticky in the short run, even if the long-run elasticity increases. In other words, the cap may exist, but it may not arrive in time to save a crowded short. Proof point 5, global arbitrage and regional premiums. When tariffs, shipping constraints, or policy fears distort flows, one region can trade at a premium to another, and that premium attracts arbitrage. Arbitrage is not a philosophical concept, it's a physical magnet. If one market is expensive relative to another, metal moves, paper hedges get adjusted, spreads get targeted, and price discovery gets dragged toward equilibrium. But the drag can be delayed if the logistics chain can't keep up, and that delay is where squeezes live. Now, let's put the calendar trigger under a microscope, because this is the why now that people treat like astrology until it hits them in the P and L. We're in mid-January, and we're heading toward the end of the month. Month-end matters because big allocators rebalance. Commodity exposures get adjusted, risk parity and vol target funds respond to realized volatility. And we're also staring at a major central bank window late in January. Whether the market expects cuts soon or not, the mere repricing of that expectation can whip the dollar, whip yields, and whip metals. Add in options positioning, particularly in silver, where round number strikes like 90 and 100 become magnets, and you have the recipe for pinning and slingshot behavior. That is, price gets pulled toward a strike because dealer hedging flows dampen moves until it breaks, and then hedging flows accelerate the move the other way. Because if this one level breaks, the math changes. Let's do that mechanism in plain language, because this is where you turn complexity into actionable awareness. When a lot of call options exist at a certain strike, dealers who sold those calls often hedge by buying futures as price approaches the strike. That buying can support price. But as price goes through the strike and the options become more sensitive, higher delta, dealers may have to buy even more to stay hedged. That's the reflexivity. It can create a gamma squeeze effect. The opposite can happen on a drop, where hedges get unwound and selling accelerates. This is why silver can feel like it has a mind of its own. It doesn't. It has a hedging program. So what does that mean for a finance-minded retail investor watching metals continue to climb while traders reposition? It means you stop treating pullbacks as moral judgments and start treating them as structure tests. Is the pullback occurring on collapsing participation, or is it occurring on heavy volume with spreads staying firm? Is the curve steepening or flattening? Are round number strikes acting like magnets? Are you seeing violent reversals around key levels? Those details tell you whether the move is cooling normally or whether it's setting up for the next leg via forced flow. Now, we have to address the counterpoint honestly, because credibility dies when you pretend only one outcome is possible. In copper, there is a serious case that the rally has run ahead of near-term fundamentals and that a correction is likely. High prices can reduce demand. Substitution to aluminum can increase. Prior tariff-driven stockpiling can unwind. And if that unwinds while specs are crowded, the downside can be sharp. In precious metals, if the dollar strengthens meaningfully on unexpectedly hot data, or if the market reprices rate cuts further out, you can see a fast retreat, especially in silver, which is leverage on leverage. But here are just the rebuttal that keeps the bull case alive. Corrections are not the same as reversals. A correction can be the market's way of rebuilding a base, resetting leverage, and inviting the next wave of allocation. And the presence of repositioning, closing exposure while price stays elevated, can make the post-correction floor higher than people expect. That's the part that matters. So let's get concrete. Here's your near-term roadmap, and we're going to keep it mechanical, not mystical. In gold, the $4,600 area is a psychological and structural zone. If gold holds above roughly the mid-$4,500 on pullbacks, call it the $4,520 to $4,560 neighborhood, and then reclaims the highs near the 4,600s with momentum, that supports the trend intact view. A clean push into the upper $4,600 and toward the $4,700 region would be the kind of breakout that forces late shorts and underhedged risk managers to act. Conversely, if gold loses the low $4,500 and can't reclaim them quickly, and if that drop comes with a risk-off dollar surge, that weakens the setup and increases the odds that the market is doing a deeper reset toward the low $4,400. Not a prediction, an if then, and that's where real discipline lives. In silver, the levels are even more important because silver trades like a coiled spring when it's crowded. The mid-80s zone is a battleground right now, with recent pricing around the $86 area on the front contract after a sharp pullback. If silver can stabilize above roughly $85 and then reclaim $90, that tells you the market is absorbing selling and the squeeze risk remains active. If it fails to reclaim $90 and starts closing below the low to mid-80s, think $82 to $84, and especially if that happens on a broad risk-off move, then the market is telling you leverage is being unwound and the next support test could be significantly lower. But that's not the part that matters. The part that matters is how it behaves around round numbers. Because round numbers in silver are not just psychology. They're options, strikes, margin thresholds, and headline triggers. In copper, watch $6 or $0 per pound like it's a line in the sand, because it basically is. If copper holds around the high fives and pushes back above the $6, 0.5, to $6.10 area, you keep the momentum regime alive, and you stay alert to a blow-off style move if supply concerns spike. If copper loses the mid to high $5 80s and can't recover quickly, especially if you see a risk-off macro wave, you should respect the correction thesis. And if you want the market structure tell, don't just watch the price, watch the curve. If nearby contracts start getting unusually strong relative to deferred contracts, that tightening is a clue. If the curve stays comfortably in contango and the front month weakens, that can validate the froth deflating story. Now we bring in the two scenario lens because this is how you keep your head when the tape tries to steal it. Scenario 1 is the controlled pullback and retest. Metals dip, volatility shakes out weak hands, and then price reclaims key levels with participation. In this scenario, you'll see pullbacks that are sharp intraday but fail to break key supports on a closing basis. You'll see the market try to break and then get bought back. That's a trend market doing what trends do, punishing impatience on both sides. Scenario 2 is continuation squeeze and gap risk. This is the one that blows up people who insist on waiting for confirmation and people who insist on fading obvious momentum. In this scenario, the market pushes through a round number level, like $4,650-ish in gold or $90 in silver, and then liquidity disappears. Stops trigger, dealer hedging accelerates, shorts cover, and you get a gap that never gives you a nice entry. It's unfair, and that's why it happens. Because markets don't exist to reward patience or courage. They exist to clear positions at the worst possible time, and that's where the real pressure starts. Now, a credibility check that matters, price can whip around violently even if the thesis is correct. That's not a disclaimer. That's a feature of leveraged markets. You can have the right macro regime and the right supply story and the right positioning read and still get a 5% flush in silver or a fast $100 drop in gold. That move doesn't disprove the thesis by itself. It's noise versus signal. Signal is the structural trend, higher lows, reclaims of broken resistance, stable curve behavior, and resilient demand. Noise is the violent intraday spike that exists purely to transfer risk from emotional hands to disciplined hands. The market will try to convince you that noise is truth. Don't let it. This is where we do the viewer psychology shield, because if you're in the metals crowd, you already know the emotional manipulation pattern. First, the rally makes you feel late, then the pullback makes you feel stupid, then the rebound makes you feel angry, then the next pullback makes you capitulate, and right after you capitulate, price resumes. That pattern is not personal. It is structural. It's how leveraged markets harvest bad timing. The antidote is not be fearless. The antidote is be specific. Specific levels. Specific time horizon, specific invalidation. If you can't say what would prove you wrong, you don't have a thesis. You have a mood, and moods get monetized. So here's a practical way to stay rational when volatility spikes. 1. Stop anchoring to the last high tick. Your brain will treat it like a fair value. It isn't. 2. Decide whether you're watching trend signals or trading noise. Trend signals live on closes and structure, not on 1-minute candles. 3. Respect liquidity windows. Overnight moves can be exaggerated. Don't let a thin session spike bully you into a full-size decision. 4. Assume headlines will arrive after the move, not before it. And 5. Remember that metals are a global market. If you see a move in one region, watch how it transmits to the rest. Transmission tells you whether it's real. Now, you might be wondering, if this is repositioning, who exactly is repositioning? It's not one group, it's a chain reaction. Some are systematic funds that follow trend and scale exposure based on volatility. Some are discretionary macro funds adjusting conviction. Some are producers hedging future output when prices become too good to ignore. Some are fabricators trying to lock in costs before price moves again. Some are banks managing dealer books, trying to stay hedged without getting run over. And some are retail participants who see the rally and chase it at the worst time. All those players push on the same market, but with different constraints. And constraints, not beliefs, are what move price in the short run. Let's talk about the street symptom you can actually observe without insider access. The violence of reversals and the sensitivity to round numbers. When a market is lightly positioned, it moves smoothly. When a market is heavily positioned, it moves like it's stepping on landmines. That landmine behavior is a signal. It means positions are stacked. While liquidity is fragile, and the next catalyst, macro data, a policy comment, a geopolitical flare-up, a sudden inventory headline, can force the unwind. The next detail is what flips the whole setup, whether that unwind is down or up. And that brings us back to the title, Traders Reposition as Metals Continue to Climb. The simplest way to interpret that is smart money is taking profit. But the deeper way to interpret it is the market is rotating risk from one pocket to another. And some shorts are covering, some longs are rolling, some new participants are stepping in, some hedgers are increasing, and when that rotation happens at high price levels, the market becomes sensitive to small imbalances. a slightly stronger dollar, a slightly weaker data point, a sudden shift in rate cut expectations, a surprise headline about tariffs or supply disruptions, a big options expiry. Any of those can produce an outsized response. That's why the calendar is the catalyst. So what comes next in the next week or two? Watch three things like a hawk. First, the key levels we laid out. Gold's ability to hold above the mid $4,500 and challenge the 4,600s. Silver's behavior around the mid-80s and the magnetic $90 level. Copper's ability to stay firm around $6 and not lose the mid to high $5 80s. Second, watch the curve, whether nearby tightness begins to show in narrowing spreads or backwardation signs. Third, watch volatility itself, not as fear, but as information. Rising implied volatility can mean demand for hedges is growing, which can amplify moves. Falling volatility while price holds can mean the market is stabilizing, which can support a healthier trend. And if volatility spikes while price chops, that can be a warning that positioning is getting stressed. Now, a subtle but important final point before we close. You don't need to marry a metal to trade it intelligently. The crowd always tries to turn a trade into an identity. Gold bugs versus dollar bulls, silver stackers versus Wall Street, copper believers versus cynics. That identity game is a trap because it makes you defend a narrative instead of managing risk. The better identity is simpler. Be the person who watches structure. Be the person who understands mechanics. Be the person who can say, here's what would confirm this and here's what would break it. That's how you survive markets that are built to exploit emotion. And if you're still here, you're already in the minority because most people want a hot take, not a process. So here's the quiet CTA and it's not begging. If you want to stay on the side of mechanics instead of the side of headlines, stick with this kind of breakdown and add your own observations. What you're seeing in spreads and intraday behavior in the way metals react to the dollar and yields. The community that wins in markets like this isn't the loudest. It's the most specific. And that's where the real edge starts. One last reminder. Because what's the difference between confidence and recklessness? The market can be right about the big trend and still punish you on timing. Respect that. Keep your scenario lens. Define your invalidation. Let the tape confirm, not your ego. And remember what the repositioning signal is really saying. Metals aren't just climbing. They're reinforcing the market to choose sides under leverage. And when the market is forced to choose, it rarely does it quietly.